Hi, I'm Jim Brogan. I want to thank all of you for tuning in today to Tax Planning in the New Age. Let me give you a little bit of an idea of how this is going to go. I budgeted about 20 to 30 minutes. I want to give you some great information, maybe answer a few questions at the end, and then you can get back to your evening. But I think this is a very important issue as we move forward in 2021. So I'm going to talk for about 20, 25 minutes. I'm not really sure exactly how much, but somewhere around in there. And then at the end, I do want to take just a few minutes for any questions. And what you'll do is if you hover your arrow, your cursor, excuse me, over the screen, you'll have a little menu that pops up at the bottom. And you'll see right in the middle of that screen, there is a chat button. And if you click on the chat button, you can type in a question. You can either send it directly to me, or to Jill, excuse me, or you can just type it in there. Everybody will see it. And then but I'm not going to answer any questions until we get to the end. But then you can kind of be ready to ask questions. Okay, so let me pull up my PowerPoint and we're about to get started. I'm Jim Brogan, and I'm with Brogan Financial, and we're going to talk about tax planning in the new age. Now, one thing I do want to mention is anytime I give a presentation like this, it's general information. So obviously everybody needs to take that information and create their own individual plan tailored to their needs. Let's talk about income taxes. Let's talk about the history of our income taxes. And what I've got here is kind of a look at some different events in history and what our highest marginal tax rates are in the United States. Now, it's important to understand, since the Income Tax Act was passed in 1913, our system has always been a marginal tax system. And what that means is whatever all of your income is not taxed at the same rate. So when you bump into a new bracket, only income over that amount is then taxed at that new rate. And that may be why you see, if you have a CPA do your taxes, it may tell you you're in a 24% marginal bracket, but your effective rate is 17%, because you're not paying 24% on all of your income. So it's always been a marginal system. But here's what I want you to see about our history. You see there in the 1920s, we had World War I, and there was a big need for money to fund the war, right? We went into debt. And then we got out of World War I, and then of course the Roaring Twenties hit. The government was doing very, very well. We had huge surpluses. Then we got into the 30s with the Great Depression. And then you see what happened there with tax rates. We had a lot of government initiatives. We had the New Deal. We had all of this government spending because we had an economic crisis. And so we had to spend money to help get out of that crisis. And then eventually that ended in World War II. And of course, then we had to spend a lot of money for World War II. And then you see that at the end of World War II, our highest income tax rate was 94%. And for most of those years, from 1946 to 1964, you'll see that the highest income tax rate was over 80%. And for most of those years, it was over 90%. So I think it's really important to understand historically, when we have had some sort of crisis, whether it's an economic crisis or a war, we have had to spend a lot of money to get out of that crisis, and income tax rates have gone up. Now then over time, as you see there, the Revenue Act of 1964 brought income tax rates down. Then we had the Economic Recovery Tax Act of 1981. So income taxes in the 70s the highest tax rate was 70%. And in the first 5-6 years of the 1980s, it was 50%. And then we had the Tax Reform Act of 1986. And that brought income taxes down to 28%, was the highest income tax rate. And you'll see there that ever since, our highest income tax rate has been under 40%. Now, I have a chart that actually maps all of the marginal tax rates, just like this does. And I didn't want to get too detailed today, but there's a correlation. I mean, when the highest tax rate goes up, all tax rates are going up. And then when it comes down, all tax rates are coming down. But look at this period from 1986 to present. If you just look at that chart visually, since 1986, what does that tax rate environment look like compared to the rest of our history? It's really pretty low. Now, I know it doesn't seem like it's low because every time we turn around, we're paying some kind of a tax. We have all these different kinds of tax we pay. We've got sales tax and property tax and fuel consumption taxes. We've got an entertainment tax. If you go to a sporting event at University of Tennessee, there's just, federal, state, and local taxes. We're taxed every time we turn around. But if you look at federal income tax rates and federal income taxes, if you look at this chart, it's very clear. We're in a low tax environment. Now, up until recently, when the federal debt has ballooned, our tax rates have gone up. And federal debt balloons when we have crisis, either economic crisis, or in this case, the pandemic of late. But if you look, that has yet to happen to a significant degree in the last 15 years. I mean, we had the Great Recession of 2007, 2009. We had a lot of government spending. Tax rates haven't gone up. And then we have the current COVID pandemic. So I'm just saying, historically, when we've started to spend a lot of money to get us out of these kinds of challenges, tax rates have followed. That has not happened recently. In fact, if you look at our federal debt, the red line here is our federal debt as a percentage of the size of our economy. When we look at how big our federal debt is, we can't really compare a number like $27 trillion today with a number from the 1960s. Number one, money is not worth nearly as much now because of inflation and cost of living. And number two, our economy is a whole lot bigger today than it was in the 1960s. So the best way to look at our debt is to look at how big is it compared to our GDP, our gross domestic product, which is the size of the economy. And if you see here, we are now as high as we were at the end of World War II. Now look at this overlaid with our income tax rate history. And it kind of goes to what I was saying earlier. When we have to spend a lot of money for crisis, tax rates have gone up. And then as the debt came down, tax rates came down. Now, please don't misunderstand me. I'm not in any way making a statement here about what's the best way to solve the debt problem. I'm not saying that we shouldn't be spending money to get us through the pandemic. So please don't misunderstand me. I'm just saying, let's look at the reality of where we are and what does that mean for where we're likely to go. So before we get too much into that, I want to talk about preparing for higher taxes in the future. Let's look at what the realities are. The CARES Act alone cost over $2 trillion. U.S. government debt is expected to rise maybe to 120 to 130% of debt to GDP by the end of this year. U.S. government debt is currently over 27 trillion, which is bigger than the size of the economy. And the Tax Cuts and Jobs Act under current law is set to expire at the end of 2025. So we actually have a guaranteed tax increase in the current system. Now, then what could happen beyond that, we don't know, but that's why we're talking about the present realities and what that may mean for our future. So I do want to first talk about the difference in tax planning and tax preparation. Tax preparation is what we do every year this time of year. We're getting our 1099s together and our W-2s if we're still working, and we're preparing our tax returns. It is a rear view mirror exercise. We're looking into the past and we're dealing with data that cannot be fixed. It cannot be reversed. If you took money out of an IRA in November of 2020, there's nothing you can do about it. You will get a 1099 on that. If you had a capital gain distribution in December from a mutual fund, it's already happened. You cannot undo it. So there's a real limit to what we can do with our tax preparation. Tax planning, by contrast, is much, much more powerful. Tax planning is looking forward to the future, and it's being intentional about what we do and how things show up on our income tax return. So we're going to get into a couple of those opportunities today, but to be clear, I'm not a CPA. You know, we don't prepare tax returns here. That's a tax preparation exercise. By contrast, tax planning is looking to the future, and it is in the long run, I think, much, much more powerful. Now let's look at where we've been with tax rates and where we're likely to go. So this shows you the effect of the Tax Cuts and Jobs Act in 2017. So you see joint filers there in the purplish color, and then down below there in the greenish color, that's for single filers. So the top line is the 2017 tax brackets. The bottom line is the 2018 tax brackets. Now these brackets have been slowly increasing because of cost of living, inflationary adjustments. But I want you to see these right next to each other, because in 2018 dollars, we are going back to the 2017 tax rates under current law in less than 5 years. At the end of 2025, we go back to the blue, to the top line. So if you look down at the bottom, that's our current tax rate. That's the amount of taxable income you would have to then move into these higher tax brackets. Taxable income is not adjusted gross income. Taxable income is after you take your tax deduction. So, you know, if your taxable income is $105,000, or excuse me, if your total income is $105,000 and you take a $25,000 tax deduction, your taxable income is $80,000. And $80,000 for a joint filer is an important number, because if you look right around that $80,000 mark for joint filers, you go from 12 to 22%. That is a marked increase in the tax rate. That's an 87% increase in the tax rate to go from 12% to 22%. Now, I want to talk about this sweet spot you have between retirement age and age 72. Now, there are opportunities after you're 72, but there's a lot of opportunity between retirement and age 72. Why? Because at 72, you're going to lose some control of your income taxes, because any monies that you saved in retirement accounts, IRAs, 401ks, 403bs, and other retirement accounts, you have to start taking a required minimum distribution at 72. And it is about 4% roughly. So you can kind of do that math. That's going to be a taxable distribution, and it's forced.
Yes.
So you're going to lose some control when you turn 72. But when you first retire, how you draw income and how you structure investments can have a powerful impact on your tax return. You know, if you draw income from things that are not taxed, or you structure investments to have tax-friendly growth, you can have a big impact on your income taxes. And then you're going to lose some of that control at 72. Well, guess what? For a lot of you listening, by the time you're 72, we're going to be past 2025. And the tax rates are going to go up. And your taxable income potentially is going to go up. So you could be in a 12% tax bracket potentially in the early years of retirement. Yet when you turn 72 and it's into the future, your tax rate could be 25 or 28%. So taxes are kind of, you know, in reality, you might have an opportunity to take advantage of what is really, truly, more than likely a low tax bracket today. You know, it's almost like taxes are on sale. They're cheaper now than they're going to be in the future. If there is future legislation to increase income taxes, that will even more so be the case. Now, the other thing I want you to see with these tax brackets is when you click from this 12% bracket to the 15 or 22% bracket, something very important happens. And it's when you're, let me back up for a second. When you're in the 10 or 12% bracket, your tax rate on long-term capital gains is 0. So let's look at the long-term capital gains rates. You know, a lot of people aren't aware that there's a 0% capital gains tax rate. So let's look at a married filing jointly. If your taxable income, now remember, this is after your tax deduction. If you're any portion of your total income that is long-term gains, if it's under 80,000, your tax rate is 0%. And when you're in that sweet spot between retirement age and age 72, if you draw income from things that have already been taxed, non-IRA types of investments, many people I meet with are high net worth, have healthy 7-figure investments, and can keep their tax rates down under 60, 50,000 of total taxable income and stay in that 12% tax rate. But that means long-term capital gains are 0. What an unbelievable opportunity. Long-term capital gains rates are one of the greatest gifts Congress has ever given us in the Internal Revenue Code. There is a risk that will be taken away in the future. Okay, but right now that's on the books. And I do think it's unlikely to change in the next couple of years for people under $1 million of income. If you look at the proposal out of the current administration, it's unlikely that would change for people under $1 million a year of income. So this 0% rate is a tremendous opportunity for many people to take advantage of, to harvest investments at a 0% tax rate. Now, I've had people come into my office that had healthy investment accounts in their IRA, and they had healthy investment accounts outside the IRA. And the problem is, are your investments structured in a way where you can actually take advantage of long-term capital gains? I've seen situations where people invest in things like stocks and mutual funds and ETFs in their retirement accounts. And then in their non-retirement accounts, they're mainly bank type of investments. Well, the problem is bank type of investments can't take advantage of long-term capital gains. You can't even get those. And monies coming out of a retirement account are taxed as ordinary income, regardless of how the gains were generated. So location, asset location is what I would call that. What investments do you have outside your IRA that potentially have opportunities to take advantage of long-term capital gains rates? But then also, what is the tax implication year to year of holding an investment outside of a retirement account? Because if it pays a dividend, if it pays a capital gain distribution in December, if it pays interest, whatever it does, you don't have control of that, and you're going to have to pay income taxes on it. It's going to be reported. With long-term capital gains, that can be a good thing. So structuring your investments and your income in a way to be able to take advantage of long-term capital gains is a tremendous opportunity. And even at 15%, if you have your capital gains then generate your income up over 80,000 of taxable income, you only pay the 15% bracket on any of those gains that push you over the 80,801 or 40,401 for a single filer. And at that point, you're in a 22% bracket. 15 is still a pretty good bargain. So taking advantage of long-term gains is very important. Now let's talk about Roth IRA. That's the other big opportunity. When you convert to a Roth IRA, you're basically taking, let's say you take $50,000 out of your traditional IRA and you convert it to a Roth. You're going to pay income tax on that $50,000 as ordinary income. And then once you've had it for 5 years, as long as you're over 59 and a half, when you pull it out, it's tax-free forever, for the rest of your life anyway. Okay, your kids would have to take it within 10 years, but it's tax-free for the rest of your life. Well, if we're looking at this situation, if I go back here and look at our tax brackets, and you have an opportunity to be in these lower brackets now, especially before you turn 72, and then income taxes are going up, and they may go up substantially more with our debt problems. And I think that's pretty darn likely. Our income tax situation in 10 years may be completely different. And at that point, you may be 72 or older. And so your income taxes on IRA distributions may be 28, 32, 33%. Whereas right now, you might be able to convert to a Roth at 12 or maybe 22%. So that's what you had the opportunity to consider with Roth conversion. Now, I do want to be clear on something. Roth conversions only, in the end, they help if when you take the money out of the Roth down the road, your tax rate is higher than it is now. Well, think about that. If you're in the final years of work, you might be making a lot more income now than you're going to be once you're retired. Now, you'd have to examine that once you're 72 and have minimum distributions from your retirement accounts. But the bottom line is Roth wins when your tax rate in the future is higher than it is now. Now, it's a moving target. We don't know where taxes are going, but this is a way to hedge the reality of what we're dealing with right now with our federal budget and our deficit spending. Okay, and the reality of the pandemic, and we're still dealing with some of the spending from the Great Recession. Now, with Roth IRA, there is an upfront tax cost because you have to pay the income tax on that money. And I meet with some people that can't afford to do a Roth conversion. You know, if you hit your investment base, I mean, if you convert to a Roth, you got to pay the income taxes now, which means your investment base is going to go down some because of the taxes you're incurring. And you have to be careful you don't hit your investment base too hard in the early years of retirement. You know, what happens in those first 5 to 10 years has a disproportional impact on the rest of your retirement over 30 years. And it's very important you not deplete your money too much in that first 10 years. So many people, you might look at it and say, well, Roth makes sense, but you may not can afford to pay those taxes up front. How long will it take you to recover those taxes? And if you hit it too hard for your income needs in the meantime, it could really work against you. But for those of you that can afford it, it's a great way to hedge income tax rates in the future. If taxes don't go up a lot, you'll be passing more tax-free money to your spouse or to your heirs. I realize you're probably wanting to focus on taking care of you, and that's great. I'm just mentioning all the advantages and potential disadvantages of something like a Roth conversion. Okay, so all of these are great opportunities. All right. The other thing I'll mention is little tax planning things like bunching itemized deductions. You know, with the new Tax Cuts and Jobs Act, with the increase in the standard deduction, according to IRS, about 90% of taxpayers do not itemize anymore. And you may not be itemizing, but it may be if you time things like your charitable contributions, or maybe how you pay your property tax. You know, it's not due till March 1st, but you can pay it early. So you could not pay it 1 year, take a standard deduction. The next year, you could bunch 2 property tax payments and charitable contributions and sales tax on a new car purchase. You know, if you're smart about how you do that. Now, there is a $10,000 limitation on the deduction of state and local taxes. That would be your property tax and sales taxes. So there is a limit to how much you can deduct in 1 year in the current law. I'm just saying being smart about how you bunch those things could end up saving you money in the long haul. Even if you have a small, like if you're deducting $30,000, you're itemizing, but the standard's 25. It may make sense for you to bunch your contributions, your deductions in 1 year and have a $50,000 deduction. And the next year, take the $25,000 standard deduction. These are simple tips that are important. Qualified charitable distributions. If you're 70 and a half or older, you can give money directly from your IRA to church or a qualified charity, and it is not taxable. It shows up on your tax return, and then it's deducted from taxable income. And it does, once you're 72, it does come straight off the taxable required minimum distribution. You can give up to $100,000 a year. So anything you're doing once you're 72 or older, you ought to be looking at the potential benefit of qualified charitable distributions. Now, to be clear, it has to be only from an IRA. You cannot do that from a 401k, a 403b, or any other kind of retirement account. It has to be an IRA. And then taking advantage of carry forwards. If you have a capital loss carry forward, or maybe you have a charitable contribution carry forward where you weren't able to take the whole deduction, good tax planning every year in the fall, you can look at how you can use that to offset things like capital gains and maybe have the ability to offset the impact of Roth conversion. So these are small things that can have sometimes a big impact on your tax. In the end, tax planning, I think, it's always been a very important part of your retirement plan and your financial plan. I think in the future, it's going to be more and more important. I think it's highly likely that in the next 5 to 10 years, our tax system changes, and maybe dramatically. I don't know how quickly, but in the next 10 years, I think when we're in the 2030s, I think it's likely we're going to have a very different tax system. So how you plan today could really have a big impact on your long-term future with your retirement plan. Now, this is one of the things we do at Brogan Financial. We don't prepare tax returns, but tax planning is this forward-looking exercise. We do comprehensive financial planning and investment management. We are a fiduciary. We're required to act solely in the best interests of our clients. If you'd like to have an introductory phone call with me personally, we would just schedule a 15-minute call. And you can ask me any questions you want. And that call will be for you to ask me questions. And then we can just go from, and if it's just take advantage of 15 minutes of my time, that's fine. And we can just go from there. You can, if you go you can email us at info@broganfinancial.com. Also, Jill is going to be posting a link in the chat. If you click on the chat button, there's a link there. You can actually, we've got some times marked next week to do 15-minute phone calls. And you can check on that link, and you can actually go ahead and book that 15-minute call directly with me to ask me questions. And I'll be happy to do that. You can also, if those times don't work, you can email us, info@broganfinancial.com, or you can always give us a call, 862-6800. Okay. Also, if you want more meat, I've got my next class is at the University of Tennessee, and it is the beginning of May. If you go to broganfinancial.com and click on classes, it's two-hour sessions, so it's got a lot more meat, and I get into all of the financial planning issues. And you can attend that either live or virtually, just like we are doing here with Zoom. Okay. Now, if you have questions, and I see I've got a question here, and I'm going to answer that. But if you have questions, feel free to type that into your chat feature. Again, if you'll drag your cursor over the screen, you can then pull up this chat button at the bottom and you can type in a question. Now, we've got a question here from John that says, what is my position on owning physical gold? So first off, let's talk about owning gold as overall as an asset, and then we'll talk about physical gold. As owning gold as an asset, gold is considered a hedge for certain economic environments where it can really surge. It's something of an inflationary hedge. It has characteristics of a fear index. When people are scared, gold can go up, not always. But in other words, gold can be an asset class, gold and silver, precious metals, that when stocks zig, gold and silver may zag. And you know, when you think about diversification, you want a whole lot of stuff in your portfolio that doesn't just move up and down together with the stock market. At least you do, and you get most people when they get closer to retirement, they don't want the big spikes up and down. So you want something zigs and others zags. So I think that the commodity category, which gold is a subcategory of commodities, I think that it is absolutely an asset class to consider for diversification. You'll be adding, that adds investments that will balance and diversify stocks. So it could help in a bad market. It also could work against you in a rising market. But it does increase, in most cases, diversification. Now, in terms of owning physical gold, personally, I don't see the real importance of that. Now, I know a lot of people like that. I don't think, even though gold has some pricing as if it is an alternative currency, I don't think gold will ever be a currency again, because there's just not enough of it to be a basis for like the dollar to go back to a gold standard. So I think it's unlikely that owning physical gold would really be a big thing. Now, I'm not against it. If you own gold coins, silver, I think that's fine if it's part of a diversified portfolio. So you could either own investment vehicles that buy physical gold and silver, or you could invest in it yourself. I just think it's important that you not have too much in one asset class like that. What if it doesn't do well? You know, it should only be used as a hedge, in my opinion. Now, we've got a question: can we roll a 401k or 403b to an IRA to take advantage of a charitable contribution? Yes. So that is one of the things that need to be considered in doing what's called a direct rollover from a company plan into an IRA. When it's a direct rollover, there's no income tax on that. It's not a taxable event. But in an IRA, you can do charitable distributions, QCDs, if you're over 70 and a half. Now, there are other issues to consider with rollover. One would be investment flexibility and investment control and choices of investment. The other would be what are the fees and the costs of the investments. But charitable contributions, QCDs, is an advantage of an IRA over a 401k or 403b. We have the same question. Can you roll, or it's really not the same. Can you roll a TSP, that's a thrift savings plan, if you work for the federal government, directly to a Roth IRA? No, not really. That would be a fully taxable distribution. Yeah, you could, in theory, you could do a direct rollover to an IRA, and then you could convert it to a Roth. But then you'd pay all the income taxes on that money. So, typically, I don't want to say always, but typically your TSP contributions and growth is going to be pre-tax money. It's not been taxed. It's more like a traditional IRA. When you convert it to Roth, you're going to pay taxes on all that. Now, you could do that with a partial conversion and only pay tax on what's converted, but you would pay tax on anything that's converted. But the cleaner way to do that would be to do a direct rollover to an IRA and then look at Roth conversion. We're also looking at a question here: can we do a Roth conversion after age 72? Yes, you can. There is no limit on age with a Roth conversion. However, you cannot do a Roth conversion until you have first taken your required minimum distribution. So if you have, let's say, a $20,000 RMD and you want to do a $10,000 Roth conversion, and you do the conversion first before you have taken your RMD, that conversion is an impermissible transaction in the Internal Revenue Code. So that is very, very important. And you cannot convert your RMD to a Roth. So you have to take the RMD first, and then you can do Roth conversion over and above that. I understand also from the question about TSP. Yeah, so I think what you're asking there on the TSP is you could do a partial Roth conversion to fill up that 12% tax bracket. But you normally wouldn't convert all of that. I wouldn't think, if it was a large balance. But bottom line is you'd want to directly roll it to an IRA first and then convert it. Now, I will mention one thing. There is a way that many of you could do a tax-free Roth conversion. And it is a tremendous opportunity that not a lot of people know about. If you have after-tax contributions in your 401k or company plan, in other words, you were taxed on that money before it went in, it's already been taxed. You can convert that directly to Roth IRA, and it's tax-free. It is a tax-free Roth conversion. And if you don't need the money for several years, for 5 or more years, that would make a lot of sense to look at considering doing that. Okay. Tell you what, we're out of time with the questions. I've got about 5 minutes over. I hope that's okay. Feel free to take advantage of me if you'd like to have a 15-minute introductory call to just ask me questions about anything at all you're concerned about. I'm happy to do it. If you would like to register for one of my upcoming classes, you're welcome to do that. Also, you can get my electronic newsletter. If you go to broganfinancial.com, you can sign up for that e-newsletter where we send out great information every week to keep you informed so you can make prudent decisions to impact the quality of your life. Thank you so much. Please stay safe and healthy, and God bless you.